Good afternoon. I'm Chris Andrews, Vice President and Head of Funds Management here at Trobe Financial, and today your moderator. We're pleased to again welcome a large number of people from across Australia for our quarterly investor call briefing. We greatly appreciate your interest and ongoing support in our investment operations here at Trobe Financial. Today, I intend to cover the following topics. The agenda is probably starting to get a little familiar to our regular attendees. First, we'll be looking at domestic macro issues and their impact on your investment performance. We're going to focus in particular on key economic indicators and drivers. So this section will incorporate our much discussed headwinds and tailwinds report. And we'll also look at the international economic outlook and any relevant impact for investors. Secondly, we'll give you our customary update on the Trobe Financial Group and our operations. And thirdly, we'll look in particular at how our retail investment fund has performed for its investors. You should be able to see on your screen where you can type in questions. Now, obviously, as usual, with the numbers we have attending today, we might not be able to get through all of the questions during this half hour. We'll answer questions on a first-come, first-served basis. If there are any questions that we can't get to for time reasons, then we undertake to follow up with you personally after the teleconference. As usual, we can't comment on individual assets or investments today in this forum, but of course our investor sales team is, as always, standing by, ready to assist you with any of these matters on 1800 818 818. Obviously got plenty to get through today, as we always do, and we appreciate that you are all on very tight schedules, so we'll keep this presentation to half an hour maximum. So first, economic issues and our headwinds versus tailwinds report. Click through. As we say each quarter, understanding the true situation of the world economy requires some significant digging behind the headlines. And with so many conflicting indicators, we can sometimes fall into a little bit of analysis paralysis. The overall picture shows an international economy, but more particularly a domestic economy that's in a reasonable position on which we can build. Questions still remain about the extent of the slowdown in emerging markets, and this is the first of the headwinds we'll talk about today. So we have the IMS estimating, for example, that the BRICS, that famous acronym, Brazil, Russia, India, China and South Africa, will grow at between 4 and 6 percentage points below their levels of 2007, the last year before the financial crisis. And fiscal balances have deteriorated considerably since then. In fact, 80% of emerging markets are growing slower than they were 3 years ago. Having said this, their growth is still impressive. And as the table on screen, extracted from the Fairfax Press, shows, emerging markets are expected to continue to outperform the advanced economies out really as far as the eye can see, out to 2050. So whilst the emerging market slowdown is down as a headwind, we don't expect it to be a substantial or significant drag on Australia's economic performance. In fact, if we reflect on this same table and we assume that there's no catastrophes or disasters in emerging markets, the bigger issue facing advanced economies like Australia is the challenge of overcoming the predicted low growth rates for all advanced economies over the coming 40 years. We're going to have to work really hard to be on this to be able to buck the trend, and I'll be talking a bit more in particular on productivity shortly. Because as the Nobel Prize winning, and it's fair to say frequently controversial economist Paul Krugman says, productivity is not everything, but in the long run, it's almost the only thing. And productivity increases, frankly, have seen the living standard of the average worker increase 27-fold since 1700, and that's in real terms. But now, as the graphs on screen from the conference board show, whether we measure by labour productivity, chart 1, or by total factor productivity, chart 2, the world still faces significant challenges on this front. There's a belief in some quarters that microeconomic and labour market reform have almost exhausted their potential for improvement. So we're looking for the next game changer to kick the world forward. Now, perhaps this is going to come from the new exciting manufacturing technologies that we're hearing about, like 3D printings or advanced robotics, nanotechnology. But until we get those really sustained breakthroughs from those technologies, slowing productivity growth remains a challenge. And if the trend continues, we're going to have to ask the question, will our children be the first generation in a very long time to miss out on the opportunity to become more wealthy than their parents? And frankly, is that a future we're prepared to face? Finally, the final headwind that we'll discuss today remains the federal budgetary pressures. And while the federal government released its first attempt to repair Australia's budgetary position a couple of months ago now, the reception's been cool, and it's absolutely by no means clear whether the key measures are going to be negotiated through the Houses of Parliament. There was an initial hit to consumer confidence in the wake of the release of the budget, although RBA Governor Glenn Stevens has noted that such responses have been temporary in the past and business confidence seems unaffected by all the controversy. But until more certainty is reached on this point, Australia's federal budgetary position remains down as a headwind, and in fact really is a question mark. Moving now to the tailwinds, the things that are driving the economy forward and driving good outcomes for investors. First thing we'd have to pick out is something that's not often noted, which is Australia's growth and its positive trend, at present at least. In fact, Australia's growth in the first half of 2012 was up on 2013, and going on the latest figures, which are not for the entire period, it should be noted, it was above trend. Now, we're going to have to express some caution about these numbers. Certainly the RBA is a little bit cautious. Again, Governor Stevens was querying whether the results were skewed by substantial rises in resources exports that won't be sustainable. And so this may overstate the true pace of ongoing growth. But in any case, it is a good, solid performance on growth that we are seeing at the moment. Similarly, we have continued record low interest rates. Now, the level of interest rates, including interest rates for borrowers, is still at a 50-year low. The cash rate, whether measured in real terms, is at zero. And whether you're talking in nominal terms or in real terms, it's certainly well above normal levels, even if we're talking about the mooted new normal, lower levels. Most importantly, the RBA still has the ammunition. It still has ammunition on interest rates. We haven't got close to that sort of zero rate boundary that's afflicted some other economies. So that is a really powerful position for us to be in. And of course, we're seeing these low interest rates having many of the effects that they normally do. Savers have altered their behaviour to look for returns in slightly more risky assets. We've seen rises in asset prices, demand for credit strengthened, and interest-sensitive areas of spending, like some areas of consumption and especially dwelling construction, have also firmed. We've seen the exchange rate decline slightly, although perhaps not by quite as much as might have been expected. So we're seeing the full effects of this very accommodative policy stance on interest rates working their way through the system, with probably more to come. Frankly, we see low interest rates supporting demand for some time yet. The next point, the third tailwind driving the economy forward, is the early signs we're seeing of the rebalancing of the economy. We all heard how important it was that the domestic economy rebalance after the mining investment boom, and as Governor Stevens said, we've seen some encouraging early signs. Consumer demand's been rising moderately, perhaps a little bit slower than it was over summer. Residential construction still moving up, and we've got intentions to invest outside the resources sector also starting to improve, although admittedly from very subdued levels. Also, the labour market's held up quite well, showing some early indications of mild improvement. These signs are early though, so we've got to remain very vigilant on this front. The final tailwind we'd like to talk about, and it's at a more macro level, and while many commentators metaphorically live and die with each monthly data release, the general indicators of economic health in Australia remain stable and benign. Now, we've spoken already about interest rates and growth. We've previously discussed our unexpectedly strong labour market. We've talked about how the exchange rate is moderated, perhaps with still some room to move. And we've had a solid but probably not overheated few years of asset value growth on average. So housing prices in particular have grown strongly over the last 18 months or so, retracing the losses of 2010 and 2012. Whilst we don't expect valuations to continue to rocket ahead, the amount of new borrowing doesn't appear excessive, although the RBA, of course, has noted that it's keeping a very close eye on the Sydney market, which has been the most bullish of markets in recent times. So overall, there are plenty of reasons for us to remain fundamentally optimistic about the future without neglecting the reality of the challenges we face as a nation. As usual, of course, we take a few moments to discuss a couple of other issues of note for investors. And one of the most interesting developments over the last few months is the release of the ASX Russell 2014 Long-Term Investing Report. We've got some headline conclusions there on screen. So this report, of course, considers what's happened in investment markets over the last 10 to 20 years. The headline figures show residential property being the top performer over the last 20 years with gross returns of 9.9% per annum, so really powerful performance. Australian shares were also solid at 8.7% per annum. Now, cash was the poorest performer with gross returns of just 3.8% per annum. If we apply the top marginal tax rate to this, of course, we see a return of just 2%, which is a negative return in real terms. So, we've got to be careful about exposures to cash. Now, the caveat on all of this, of course, is that past performance is not a definitive guide to future performance. We all know that. Long-term asset class performance measurement, well, it's always significantly affected by the start and end date of the data. Nevertheless, these figures and this report is one good indicator for investors looking for asset classes that perform over time. The second issue we'd like to hone in on a little is our new parent-to-child or P2C product initiative. One of the biggest challenges facing Australia today is how our young people can get their foot on the property ladder. According to the ABS and RP data, over the last 20 years or so, median house prices as a proportion of household income have increased dramatically. To take one example, in 1994, the median house in Sydney cost around 3 times New South Wales median household incomes. By the end of 2013, as the table on screen shows, the median house cost 6 times household incomes. And this trend has been repeated across Australia and frankly threatens to turn our nation into a class of renters. Now, to a surprising degree, we have seen personally, and the economy has seen generally, parents stepping into this market to assist their children with an initial house purchase. Now, this is a very heartening development. It's the sort of response we'd like to see to these sorts of pressures. It's really important in our view that very careful thought be given to the best structure for this assistance. For example, if parents simply go as guarantor for a child's loan, the parents themselves are exposed to significant liability in the event the child defaults. Similarly, if the parents give money as a gift to children, that money may be lost to the family altogether if the child goes through a relationship breakdown. On that basis, we at Trobe Financial put our minds to how we could address this issue, and we developed our P2C, parent-to-child or P2C product. I've arranged today for our Head of Product, Corey Bannister, to explain how this innovative product works in a practical sense. So just bear with me while I get him online. Thank you for that. I think we have him online now. Corey, welcome. Tell us more about the P2C product.
Thanks, Chris. Thanks for having me on. The P2C product matches a parent's investment in Latrobe Australian Mortgage Fund's direct investment option to a loan made to their children by Latrobe Financial. It is a fully matched transaction. First, the child will apply to Latrobe Financial for the loan, completing our standard application form, which enables us to do a credit history search, and we ask them to provide verification of their income, which we use to assess their serviceability of the loan. Our standard approval process applies, ensuring their objectives and requirements are met. We arrange for a full valuation of the security property to be completed by one of our independent panel valuers to confirm the property's value, and we actually provide a copy of this to the parents as the investor in the loan. Once the parents have confirmed the terms of their investment to us, such as a desired return, investment term, etc., we'll provide a loan offer to the child, an SPDS for investment to the parent, and we'll instruct our panel solicitor to prepare the appropriate mortgage documentation in readiness for registration. Once all parties have accepted and returned their contracts, the parents will be called upon to deposit their investment capital in their cash and mortgages account, and the child's loan is booked for settlement. Upon completion, the child gets to realise their dream of home ownership.
Okay, so let's just clear up a couple of points. You said the parents set the terms of the loan?
That's correct, Chris. The parents nominate their desired return, and we add a 0.75% management fee to this to derive the borrower rate. The management fee contains a 0.25% per annum ongoing trail commission payable to the introducer of the product. The parents can also set the loan term.
And then the parents receive actually a physical copy of the valuation of the property that secures their investment. That's interesting.
Absolutely. We'll instruct one of our independent panel valuers to conduct an on-site inspection and provide a fully registered valuation for mortgage purposes. and like any direct investment, the investor is certainly entitled to receive a copy for their review prior to committing to the investment.
Okay, so you mentioned that you instruct panel solicitors to prepare a registered mortgage. So are all investments via the P2C product secured by a mortgage?
They are, Chris. Either a first or second ranking registered mortgage, depending on the assistance provided, is prepared by our panel solicitors and lodged at the titles office in all cases to properly secure the parent's investment. And this is one of the key benefits of the P2C product, in that unlike a gift, the parents have rights to the property to ensure they are protected in the case that the loan is not repaid, there's a dispute, or the child experiences a marital breakdown resulting in divorce and sale of the asset. With the P2C product, the parents receive their investment at the point of sale rather than half of it going to the previous son or daughter-in-law as part of their settlement.
Thanks, Corey. Before we finish up, are there any other benefits to the P2C product you'd like to share with us?
There are. The other topical point at the moment really affects the child. One of the potential benefits is the avoidance of costly lenders' mortgage insurance premiums if the first mortgage can be limited to 80% of the property's value, which is the typical maximum loan-to-valuation ratio before many lenders require this additional insurance. Often, when first-time buyers are looking at affordability of housing, they consider the government stamp duty obligation and lenders' fees, but do not consider that lenders are also looking to charge a lender's mortgage insurance premium, which can typically run to tens of thousands of dollars on what is a typical first home purchase. Parents can keep this money in their children's pocket by providing assistance to that level.
So the idea of P2C is not only to get children into homes, but also save them a lot of money.
That's correct, Chris. The product's proving to be very popular with our third-party origination partners who are providing plenty of inquiry for it.
Thanks for your time, Corey. We certainly appreciate it. If any of our interested would like additional information, like to discuss it further with you, who should they call?
You can call our sales team, Chris, on 1800 707 707, and one of our experienced staff can provide the information for them. Thanks, Chris.
Thank you, Corey. Corey Bannister, our Head of Product here at Trobe Financial, just talking about this P2C program, which is, of course, one of the ways we are looking to adjust, adopt and adapt to this new environment where first housing affordability is really an issue facing the entire economy. Moving on now, we press forward with our presentation and we move to the Trobe Financial Group update. So this is obviously something we like to do each quarter, just to give an update on how the Trobe Financial Group as a whole is tracking. And again, we've had a really good quarter. Trobe Financial has seen really powerful performance across, in fact, the entire June quarter, which has been really good. In terms of awards and recognitions, we've had the Pool Mortgages option of the Trobe Australian Mortgage Fund receiving its recommended rating and having that affirmed by two independent ratings houses, Zenith Investment Partners and Lonsec. Now, whilst ratings are only one factor to consider when investing, we believe that this is an outstanding result. The ratings process is an exhaustive and a comprehensive one that we fully embrace because of the accountability and transparency that it engenders. The full reports can be viewed on our website at www.latrobefinancial.com.au. And as we reported last quarter, really pleasingly for the second consecutive year, our marketing and events manager, Katerina Neshi, was nominated for the Rainmaker Max Awards. I am really pleased to report that she won. It was awarded Marketer of the Year, an outstanding achievement for an extremely dedicated and hard-working member of the Trobe Financial team. Very richly deserved, and I think anyone who has been watching the industry over the last 3 to 4 years would agree with that. At an operational level, things have really been quite hot. We're on track for a record year of originations, expecting around $2 billion or perhaps a little bit over of originations this year, and settlements are reflecting this, with June settlements, frankly, at or near record levels. Most importantly, however, and this is something we take really seriously, we're building and delivering these volumes without compromising on our service standards. In most cases, still offering same-day indicative approvals on loan scenarios. In June, while our funds management team, we also rolled over our fund product disclosure statement. This process incorporated some real enhancement, particularly to the application form, and that'll make it even easier to deal with this on the investment side. I'd encourage you to review our new PDS at our website or by obtaining a copy by calling 1800 818 818. The PDS rollover was accompanied by the acquisition of a $50 million loan portfolio and a portfolio of investors from a Victorian finance company. Coming out of that, we've appointed 3 new authorised reps from the very substantial legal practice of SLM Law in Colac. So Stuart Holbury, David Casey and Ellie Boyd, a welcome addition to the Latrobe Financial network of authorised representatives. And finally, our asset origination team continue to work hard with some of our aggregator partners on a series of broker educational seminars. Now, this is part of our ongoing commitment to contributing to excellence in the financial services industry. Really looking forward to that. We find that a very useful process indeed. At a distribution level, as discussed above, we've launched our new parent-to-child product, so that's attracting a lot of attention in the media and a lot of attention from parents and children who have been running the phones hot, looking for more information about this product. Our wealth management products, well, they're attracting a lot of attention too. It's been a very pleasing quarter there. We've been forming relationships and seeing a number of investments from overseas investors looking to capitalise, or some of them at least, looking to capitalise on Australia's excellent significant investor visa program. We're following that up with a seminar series in China delivered by our Chief Wealth Management Officer, Randall Williams, to some of China's largest financial and investment institutions. So a very prestigious lecture series there conducted by Randall Williams. We've been working with on a national PD presentation schedule with Australia's largest financial advice group. And our asset origination team sent actually one of the industry's biggest teams to the MFAA conference in May. Again, evidence of Latrobe Financial's enduring commitment to working closely with the broker channel. If we look at from a financial perspective, all of our key financial metrics strengthened across the June quarter, as you can see from the slide on screen. The March quarter's results are in brackets for comparison purpose. Our number of registered members continued to climb and reached 21,877 members. Retail funds under management, well, that's grown to $748 million. The pool mortgages option, well, that's continued its own growth trajectory. It's at $310 million at the quarter's end. So all in all, a really strong, solid quarter for the Latrobe Financial Group. So if we turn then and hone in on the fund itself and its performance for our investors, I should start by confirming, as I usually do, that our cash and mortgages and pool mortgages options continue their proud history of never freezing redemptions and never returning a cent of loss to investors. Both maintain strong distribution rates. Our contributory options continue to see a lot of activity, once again coming from the SMSF sector in particular and across a range of loan types and geographic locations. So all very positive signs there. The June quarter average returns of the CMO and PMO, the cash and mortgages option and pool mortgages option, generated healthy premia over the benchmarks. For CMO, it was a premium of 1.70% per annum. For the pool mortgages option, it was 2.01% per annum on an annualised basis. The CMO's benchmark is the official cash rate, which is, of course, the best proxy for its performance profile over time and the most relevant comparator for investors. The pool mortgages options benchmark is the UBS Bank Bill Index, which is a common benchmark, obviously, for cash-correlated fixed interest type investments, plus a margin of 1.5%, which reflects the risk-return profile of the pool mortgages option. Longer-term performance of both option continues to be very strong, certainly reflecting the strength of our investment philosophy in what still appears to be an extended period of historically low market interest rates. If we look at things graphically, well, we can see the pool mortgages option on screen against various 12-month term deposit indices. Over the quarter, the pool mortgages option slightly increased its margin over the average 12-month term deposit rates of the Big Four Bank, which you can see there as the bottom line at the bottom of the screen. This is extremely powerful performance for investors, although I make a point of noting, as we always do, that the pool mortgages option and the cash and mortgages option for that matter is not a bank deposit and it is not subject to the federal government deposit guarantee. In the same spirit, though, we look at the cash and mortgages option. We have on screen now the CMO's returns in comparison to key online account indices. And you can see that's a pretty typical return profile. You can see how it's continued to perform across in relation to those online accounts, and that's inclusive of bonus accounts. So we don't try and compete with the best bonus accounts rates, but we try to provide a really strong, reliable return that will be competitive with those bonus accounts and certainly significantly superior to the base rates. Moving now to put the pool mortgages option in particular and focus on those returns in context, we turn to our comparative annualised return series, and we do this since the inception of the pool mortgages option. The other asset classes considered, of course, are Aussie equities, property securities, global equities, Aussie fixed interest and cash, and you can see the pool mortgages option being the thick orange line running through the middle of the screen. And as we frequently point out, whilst each investment type has its own merits, this picture encapsulates really powerfully what we are trying to deliver for our investors in our own asset class. Regular, low volatility income that is uncorrelated to other key markets. When considered on an accumulation basis, obviously that sort of performance produces a very strong absolute return. The graph on screen shows the performance of $100,000 invested into the pool mortgages option at inception against other key asset classes over that period. And you can see the powerful returns that the pool mortgages option has produced. So in summary, Australia's economy is still solid. You know, there are always risks, but the doomsayers, as usual, are overstating their case. There are risks that we face. We've discussed these at length, both in this seminar and others. But looking at the key domestic economic indicators over the last few years, frankly, it's difficult to be too negative. Australia remains geographically and economically positioned to benefit from the Asian century. As we've previously said, to capitalise on this, we are still going to have to make the tough structural reforms that are required to reposition our economy for the challenges, and in particular perhaps the demographic challenges ahead. And there is absolutely no reason for us to be unduly frightened about these changes, provided, of course, and I say it again, we can summon the national and political courage to do so. At La Trobe Financial, we remain very much committed to building our business, obviously, on a very solid and sustainable basis. We remain very client-focused, both on our investors and on our borrowers, and we look to deliver for them from a position of strength. And we've got a strong balance sheet, very healthy growth indicators, and an increasingly diversified funding base. On that note, in the time remaining, I'd like to address a couple of questions that have arisen, and I turn to them now. And the first question is from Paul, who says, how does the P2C product differ from a parental guarantee? Thanks, Paul, for the question. A parental guarantee involves, if we just think about this first from a legal perspective, it involves the child as the borrower signing a loan contract. The parent then guarantees the performance of the child's performance of that loan contract. So, of course, if the child defaults, the parent can be on the hook for up to the full amount, depending on the precise terms of the guarantee. That, of course, exposes all of the parent's assets, not just perhaps a nominal amount that the parent may have advanced to the child, to the risk of collection from the lender in the event of the default. Of course, the P2C product is designed to limit that. So in the P2C case, the parent invests a finite amount to the child, and that child is and it is that amount, if you like, that limits the exposure of the parents. So if the child, for example, defaults on the loan and the lender is forced to call up the loan, it is that amount which is at stake for the parent. So it's protected the rest of the parent's assets. So that's the key difference as you look at them. I see a couple of questions about the P2C product asking for further information and fact sheets. My recommendation there would be to call our our lending team on 1800 707 707, as Corey said. That's the place to get the best information, and we've got questions about whether an SMSF can invest in the P2C mortgage. In principle, yes, but again, we'd ask you to direct those questions to our asset origination staff on 1800 707 707. We might have time for one more question here, and I turn to a question from Tim, who's asking. Talking about the RBA research report released yesterday, which was discussing whether or not it might be better for investors from now on to rent rather than to buy their home. Now, look, that's a big question, and one frankly worthy of a lot of discussion. What I'd say is this: the RBA has a number of tools open to it. On this occasion, it might have opted to, shall we say, pull the jawbone lever. Certainly parts of the market, especially Sydney, have started to look perhaps a little bit toppy. Certainly Sydney's seen 15% year-on-year growth, and that's unsustainable, of course, in the longer term. Because of this, because a lot of this is investor-driven, the RBA clearly believes it's worthwhile to inject a note of caution into the market, although it should be noted too that the RBA explicitly, in the report itself, specifically excluded investment purchases as a consideration. More broadly, though, the real issue with housing affordability is the fact that house prices have increased so much over the last 20 years that we are looking at creating a nation of renters. And that, of course, obviously, as we've discussed, is one of the drivers that's led to our P2C product. So the issue of buying versus renting never goes away. You certainly can't say in any overall sense that renting is better than buying. There are behavioural disciplines of buying a property, enforced savings, if you like, that can actually produce better outcomes for borrowers at times. But as with every investment decision, it's a case-by-case consideration. You have to consider the quality of the asset that's being purchased, you have to consider your ability to service the loans, and you have to go through all the normal investment decision-making processes that you would make for the purchase of any investment. That's all the time we have today. We have a number of questions still remain outstanding. So Tracy, Scott, Kit and others, I'll get back to you following this webinar. I should note that this webinar will be available on our website in the next few days, so that will certainly give you the opportunity if you've missed any part of it or like to revisit any of it. In the meantime, I thank you very much for your attendance and look forward to talking with you again. Thank you very much, ladies and gentlemen.